Welcome to the deep dive. Today we're really digging into a key question for New Gold Inc.
Yeah, the big one.
Exactly. After all these years of heavy spending and, strategic changes, have they actually hit that inflection point? Are they finally turning into that consistent free cash flow generator shareholders have been waiting for?
Or are there still some, let's say, significant bumps in the road ahead? It's a critical question.
We're talking New Gold Inc., ticker NGD. They're an intermediate gold miner based in Canada, trading on the TSX and also the NYSE American.
All right.
So our mission today is to really unpack their operations, take a hard look at the management team, the financials, and then get into what the market thinks, who owns the stock, and crucially, the risks.
The goal is to figure out if this promise of a lower cost, higher margin future is, well, actually within reach for them.
Definitely. And hey, while we're diving deep into NGD today, just a quick reminder to like and subscribe to the One Trillion's YouTube channel. We cover all sorts of mining companies, and seriously, we do take requests for stocks you want us to look at in the precious metal space.
We really do.
Okay, let's get started. First things first, understanding the core business. Let's kick off Chapter 1, Business Analysis. Understanding the bedrock.
Okay. So New Gold, they're what you'd call a traditional miner and operator. Meaning they do everything themselves. Exploration, development, building the mines, running the mines. It's very hands-on. It's also super capital intensive. But the upside is direct leverage to gold and copper prices. It's totally different from, say, a royalty company that just provides financing.
Right, and they made that huge shift back in 2018, didn't they? Getting rid of the international stuff.
Exactly. Sold off Mesquite in the U.S., Peak Mines in Australia. The whole idea was to become purely Canadian-focused.
And that's a big selling point for them now, right?
Yeah.
Jurisdictional safety.
Absolutely. That's key to their story. So now everything's in Canada. You've got the Rainy River Mine in northwestern Ontario. That's a big open pit with underground development happening.
Yeah.
And then there's a new Afton mine in BC. That one's an underground block cave mine, primarily gold and copper.
Block cave. That sounds complicated. What exactly is
It is pretty sophisticated. Basically, you undermine a massive chunk of ore, let it collapse under its own weight, and then pull the broken rock out from tunnels below. It costs a fortune to set up, huge upfront investment. But once it's going, it can be super efficient, much lower cost per ton than many other underground methods. It's absolutely central to their plan for New Afton's future costs.
Got it. So they're mostly producing gold, but those byproducts, copper, especially from New Afton, they help lower the overall costs.
Precisely. The copper revenue essentially gets credited against the gold production costs, pushing down that all-in sustaining cost, the AISC.
And like everyone else, they've been dealing with falling ore grades, right? So they've been spending a lot to get to better stuff underground.
That's been the big push for several years now, counteracting those declining grades you see industry-wide.
So has it worked? What do the numbers show?
This is where it gets interesting. Looking at the last, say, 4 years, gold production has bounced around a bit. 286,000 ounces in 2021, up to about 298,000 in 2024.
Okay.
Copper dipped a bit, from around 62 million pounds down to 54 million. Grades have fluctuated too. But the really critical metric, the consolidated AISC,
Yeah.
it peaked really high in 2022, over $1,800 an ounce, but then dropped to $1,434 in 2023, and then significantly $1,239 in 2024.
Wow, $1,239. That's a massive improvement. But can they keep that up? Is this sustainable or just a blip as these new zones start contributing?
That is the question. The entire investment thesis honestly hangs on whether that downward cost trend continues. It all depends on ramping up those higher-grade underground zones, the C-Zone at New Afton, Intrepid at Rainy River. That's the plan.
Okay. And how long can they keep producing at current rates? What's their reserve life look like?
Their reserve life index, based on their proven and probable gold reserves as of the end of 2024 in their 2025 guidance, is about 8.5 years.
8.5 years. That gives them a decent runway, medium term at least.
It does. And proven and probable, just to be clear, that's the highest confidence category.
Yeah.
It's what they know they have economically.
And what are they actually selling?
Primarily gold doré bars. That's like a semi-pure mix of gold and silver that goes off-site for final refining. And copper concentrate, which also contains gold and silver, sold to smelters who extract the metals.
Okay. And in the mining world hierarchy, where do they sit?
They're what we call an intermediate producer.
Yeah.
Generally, that's in the 300,000 to 400,000 ounces of gold per year range. Market cap around $4.7 billion currently. So Bigger than the juniors, but smaller than the big seniors like Barrick or Newmont.
So the pitch to investors is basically Canadian assets, leveraged to gold and copper, plus this turnaround story focused on growth, lower costs, and eventually serious free cash flow.
That's the essence of it, yeah.
All right, let's pull back and look at the bigger picture. Let's do an industry analysis. What are the market trends like right now?
Well, the market environment has been, frankly, exceptionally good for precious metals.
Yeah, gold prices have been pretty wild.
Absolutely. Gold's been well above $3,500 an ounce as of September 2025, driven by, geopolitical stuff, central banks buying like crazy, expectations of rate cuts.
And silver and copper are following along.
They are. Silver's over $40, copper strong around $4.50 pound. And the big banks, Goldman, JP Morgan, they're forecasting gold potentially hitting $3,700, even over $4,000 an ounce long term. So definitely a bull market feel.
That helps the revenue side, but what about costs? What are the big pressures, especially operating in Canada? ESG must be huge too.
Oh, definitely. Costs are always a challenge. Energy, diesel, electricity, that can be 20–30% of your operating costs right there. Skilled labor in Canada isn't cheap. Consumables too, steel, explosives, chemicals. And ESG, yes. Canadian regulations are tough. Things like the Towards Sustainable Mining Initiative, tailings dam safety rules, carbon reduction targets, it all adds compliance costs. Plus, community and First Nations engagement is absolutely non-negotiable for getting permits and just operating smoothly.
So who are they directly competing against?
Mostly other intermediate producers with a North American focus.
Yeah.
Think companies like Alamos Gold, AGI, maybe IM Gold, IAG, Kinross Gold, KGC. They're in that same kind of weight class.
And that Canadian regulatory environment, you said it's stringent. Is that ultimately good or bad for them?
It's a double-edged sword, really. High compliance costs, yes. Permitting takes forever, easily 5, sometimes 10 years from finding something to actually producing metal.
Wow.
But the flip side is stability. Once you have your permits, you generally have strong security of tenure, less risk of governments changing the rules overnight like you see in some other places.
And it keeps competitors out, too, presumably. The barriers to entry must be massive.
Immense. You need like over $1 billion just to build a modern mine. You need highly specialized people. You have to navigate those complex regulations. And fundamentally, finding an economic ore body is just plain hard. They're rare.
So the competitive advantage, the moat in mining, really comes down to having good assets and keeping costs low. You mentioned New Gold hasn't always been great on costs.
Historically, no. They were often in the higher cost quartiles, 3rd or 4th, which makes their current strategy so critical. Their entire focus now is on achieving and sustaining a cost advantage.
Okay, let's look at the numbers again. How does their 2024 cost compare to peers, and what's the goal for 2025?
Right. So NGD's actual 2024 AIC was $1,239 per ounce. Their guidance for 2025 is quite aggressive, $1,025 to $11,125.
That's a big drop.
It is. Now compare that. Kinross, maybe $300, $350 in 2024, guiding towards $1,500 for 2025. Bengold, very high, maybe $1,800 in 2024, guiding the Afton $640, $720 for 2025. Alamos Gold is closer, around $1,175 for both years.
So if New Gold hits that 2025 guidance,
they go from being a relatively high-cost producer to potentially one of the lowest cost among their Canadian peers. That would be a huge competitive advantage.
But we've seen guidance misses before, right? Especially with complex underground ramp-ups. What are the real hurdles to hitting that number, and how confident should we be given their past track record?
That's the crux of the risk, isn't it?
Yeah.
The hurdles are significant. It's about flawlessly executing the ramp-up of 2 complex underground mines simultaneously, dealing with any unexpected geological issues, controlling inflation on things like labor and supplies. It's tough.
So confidence level?
Well, the appointment of Patrick Godin as CEO, who's known as an operator, was a clear signal. And the trend is positive. They have brought costs down steadily since 2022. So there's reason for cautious optimism, but execution risk is absolutely the main thing to watch.
Okay. But putting costs aside for a second, their most unique asset might just be that jurisdictional profile when you say 100% Canada?
I agree. That pure play on a Tier 1 jurisdiction definitely offers a safety premium that many others don't have.
And that probably plays into their hedging strategy, or lack thereof.
Almost certainly. They're largely unhedged. Management is essentially saying, we believe costs are coming down, and we believe gold and copper prices are going up, so we want full exposure. It maximizes upside potential.
But also downside risk.
Exactly. No safety net from hedges if prices fall.
Okay, that gives us a good handle on the business itself. Now, let's talk about the people making the decisions. This can be make or break in mining. We're moving to chapter 2, management evaluation, the people steering the ship.
Absolutely critical. You can have the best rocks in the ground, but if the management team isn't top-notch, especially during a complex phase like this, things can go sideways fast.
So the CEO is Patrick Godin, came in November 2022, was COO before that, described as a hands-on operator. That sounds deliberate.
Very deliberate. The company had historical struggles with operational execution and keeping costs under control. Bringing in Godin, with his specific background, was meant to address that head-on.
What's his track record look like?
It's relevant. He was COO at Pretium Resources, navigated the complexities of the Brucejack mine, which Newcrest eventually bought. Before that, he was COO, then CEO at Stornoway Diamonds, overseeing the build and operation of the Renard mine.
So experience building and running complex mines?
Exactly the kind of experience New Gold needs as they ramp up these big underground projects.
And the message from the board seems clear. Focus on operations. Is that what you hear in their communications?
Consistently. On earnings calls and presentations, the focus is always on safety first, then delivering on guidance, hitting milestones, and generating free cash flow. Operational discipline is the mantra.
And are they transparent? Do they give investors enough information?
I'd say their transparency is quite high. Detailed quarterly reports, analyst calls, they provide multi-year guidance, which is helpful, technical reports on the mines, even an annual sustainability report covering ESG. Investors get a pretty good look under the hood.
Okay, let's talk capital allocation. They're spending a lot on these underground expansions. Is it the right move? Is there a risk they're spending too much?
Well, their strategy is very clearly focused on internal growth, growing from within, optimizing the assets they already have.
So not chasing big acquisitions.
Exactly. They're de-emphasizing large M&A. In Q2 2025, for instance, nearly two-thirds of their capital spending was labeled growth capital. Basically, money going into those underground expansions at Rainy River and New Afton. Plus, near-mine exploration. It's about making their existing mines bigger and better.
What about giving money back to shareholders? Dividends? Buybacks?
Not yet. Right now, New Gold doesn't pay a dividend, and they don't have an active share buyback program running.
Priorities are elsewhere.
Yeah, the priority is finishing these growth projects, getting the free cash flow really pumping, and strengthening the balance sheet. But importantly, they're saying they're exploring options for returning capital in the future now that cash flow is improving. That's a signal investors look for.
And what about return on invested capital, ROIC? It's sitting at 16.01%. What does that tell us?
That's 16%. I think it likely marks that inflection point we talked about earlier.
How so?
Well, for years, ROIC was probably held down by all that heavy investment, all that capital going into the ground without generating full returns yet. Now, as that spending winds down and the higher margin production from underground ramps up, profits should start growing faster than the capital base.
So ROIC should structurally improve from here.
That's the expectation. That's the core of the turnaround thesis manifesting in the financial returns.
Okay, that sets us up perfectly. Let's connect all this to the numbers. Chapter 3, financial analysis, reading the ledger. What are the key takeaways here?
Right. Looking at the financials, as of early September 2025, you really see a company in transition. Market cap's around $4.7 billion.
Right.
Revenue, trailing 12 months, is just over $1 billion.
But that's growing fast, right?
Projected to grow significantly, from about $600 million in 2022 to potentially $1.4 billion in 2025 if things go to plan.
And margins?
Trailing 12-month margins are decent, gross around 35%, operating 27%, net 14%. But the key is, these are expected to expand further as those lower costs kick in.
You mentioned those margins should expand as the lower cost zones come online. What exactly does that mean for efficiency? Is it just about lower costs, or are they getting better at the whole process?
It's a bit of both. Lower direct mining costs are the biggest factor, obviously. But these modern underground methods, like block caving, can also be more efficient in terms of tons moved per person, energy consumption per ton, that sort of thing. So yes, it implies an improvement in overall operational efficiency, not just finding cheaper rock.
And the big one, free cash flow, FCF.
The most critical trend, absolutely. After years of being negative or barely there, it flipped positive. $85 million for all of 2024, then $25 million in Q1 2025, and a record $63 million just in Q2 2025.
That Q2 number really stands out.
It does. It's concrete evidence that the investments are finally starting to pay off, generating actual surplus cash after all expenses and investments.
What about overall financial stability? How consistent are earnings? What's the debt situation?
Earnings consistency. Well, it's been patchy, historically. They actually had net losses in 2022 and 2023, but they got back to profit in 2024. And analysts are forecasting a really sharp jump in earnings per share for 2025, runs of $53, and even higher, $30.97 for 2026.
Big expectations there.
Huge expectations. On the debt side, their debt-to-equity ratio is about 0.60 or 60%. That's generally considered manageable for a miner. And crucially, they refinanced their debt back in March 2025, pushed out maturities to 2032, extended their credit line to 2029. That really helps de-risk the balance sheet.
Okay. I saw their current ratio is 0.89, that's below 1.0, which sometimes raises flags about short-term liquidity. Is that a concern here?
It's a fair question to ask. Normally, below 1.0 isn't ideal, but in New Gold's specific case, it's generally seen as a lagging indicator from that heavy investment phase they just went through, rather than a sign of immediate distress.
Why is that?
Because you have to look at the other liquidity metrics. They have over $225 million in cash sitting there. Total liquidity is over $450 million when you include their undrawn credit line. And importantly, their operating cash flow is strong, over $270 million in the first half of 2025 alone. So they definitely have the cash coming in to cover near-term obligations. That ratio should improve as CapEx continues to fall.
Makes sense. Dividend stability isn't applicable since they don't pay one.
Correct.
All right, let's shift to valuation. How does the market value NGD right now?
Okay, on a relative valuation basis, their trailing PE ratio is high, around 32.2. That reflects the lower earnings of the recent past.
Well, looking forward.
The forward PE, based on those much higher 2025 earnings estimates, drops to around 11.7. That looks much more reasonable, maybe even inexpensive if they hit those targets.
Big if.
Always a big if, with forward estimates. Their price-to-cash flow ratio is about 10.7, which is pretty standard for a gold producer. And another metric people look at is enterprise value per ounce of reserves. It's roughly $1,728 per ounce for NGD. It's just a rough comparison point.
So that forward PE of 11.7, does that mean the market thinks it's cheap, or is it just pricing in the turnaround perfectly? Is there still upside if they deliver?
It suggests that if they deliver exactly as expected, the current price isn't outrageous. It's pricing in as successful execution. If they beat expectations, or if gold prices move significantly higher, then yes, there could certainly be more upside from here. But it also means if they stumble, the downside could be sharp because that success is already partly baked in.
Okay. What about intrinsic valuation, like a DCF model?
Right. A discounted cash flow model tries to estimate the fundamental value based on future cash flows. It's just an estimate, of course, very sensitive to assumptions.
What kind of assumptions go into that?
Key things are long-term gold and copper prices. For an educational model, you might use something conservative, say $2,500 gold, $4 copper. You'd plug in production and costs based on their guidance, assume capital spending tapers off as projects complete, and use a discount rate, maybe 8–10%, to account for risk and time value of money.
And what does a model like that suggest for NGD?
Based on those kinds of conservative assumptions, an educational DCF could point to an intrinsic value somewhere in the range of $6 to $8 per share.
Okay, $6.50 to $8. That's interesting compared to the current price.
It suggests potential undervaluation if they execute the plan and if those commodity price assumptions hold. Lots of ifs, but it provides a fundamental benchmark.
Definitely food for thought. Let's see how that aligns with what the market is thinking. On to Chapter 4, Market Sentiment. The crowd's verdict. What's Wall Street saying?
The general feeling seems to be cautiously optimistic. Analyst ratings lean towards buy or hold.
Any specific number?
Yeah, one survey I saw had 50% at strong buy or buy, but 36% at hold and 14% at sell. Another was even more bullish, 70% strong buy or buy, 30% hold. So generally positive, but not unanimous.
What about price targets? The average seems to be between, what, $4 and $5.66. But the stock's trading near $5.90. What does that gap tell us? Are analysts behind the curve?
That's a great point. It strongly suggests the market action has outpaced the average analyst target. It could mean investors are more bullish than analysts, maybe anticipating better than expected results or faster upgrades, or analysts might just be waiting for more proof, maybe another quarter of solid execution, before raising targets further.
So the upcoming earnings are key.
Absolutely critical. Q3 results are due October 28, 2025. Consensus EPS is around $17.18. That would be a big jump from Q2, mainly because production is expected to be higher in the second half of the year. Hitting or beating that will be a major catalyst.
And the general news flow, the media tone.
It's definitely shifted, become much more positive recently. Less focus on past problems, more on the successful execution, the strong FCF generation, hitting those key project milestones.
What about technical indicators, the stock price itself?
Well, short interest data wasn't readily available for this look, but the price action is strong. The stock's up over 140% in the past year. It's trading well above its 50-day and 200-day moving averages. That confirms a solid technical uptrend is in place.
Okay, strong momentum. Now, who actually owns this stock? Let's look at Chapter 5, ownership structure. Who owns the gold?
The ownership structure is interesting. It's dominated by institutional investors, pension funds, mutual funds, hedge funds. They hold somewhere between 58% and 64% of the shares.
Spread out pretty wide.
Yeah, across more than 370 different firms. That generally lends credibility. It means a lot of professional investors have looked at it and decided to buy in.
Any big names among the top holders?
As of mid-2025, yeah. You see names like Van Eck Associates, they run the big gold miner ETFs, Condire Management, Renaissance Technologies, Arrow Street Capital, Morgan Stanley. Having these kinds of sophisticated players involved suggests they see potential in the turnaround story.
What about insiders, management and the board?
Insiders collectively own about 3.76%. That's worth over $120 million, so they have significant skin in the game. The CEO, Patrick Godin, owns about 0.04%.
Have they been buying or selling recently?
Interestingly, no reported open market buys or sells from insiders in the last 12 months.
What do you make of that? Good sign, bad sign?
It's hard to say definitively. It can mean they're confident and happy to hold. It could also be due to blackout periods around earnings or other events. It doesn't scream bearishness, but it's not a strong bullish signal like heavy insider buying would be.
And ownership concentration, is anyone controlling it?
No, it's pretty dispersed. No single entity holds a controlling stake. The top 25 shareholders together own just under half the company. And individual investors like you and me hold a pretty significant chunk, about 32.6%.
So retail has a decent voice here.
A meaningful collective voice, absolutely.
All right, this is crucial. Let's talk risk. Chapter 6, risk assessment. What could go wrong? Let's use a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Sounds good. Let's start with strengths.
Okay.
Big one, the Tier 1 jurisdictional focus. Being 100% in Canada is a major plus, removes a lot of political risk. Second, they have a defined growth and cost improvement profile. It's not vague. They've laid out a clear 3-year plan with targets.
Measurable milestones.
Exactly. Third, their strengthened balance sheet, thanks to that refinancing and growing cash flow. And fourth, the operationally focused leadership with Godin at the helm, which seems laser-focused on execution.
Okay, those are compelling strengths. What about the weaknesses?
The biggest one is probably asset concentration risk. They really only have 2 producing mines, Rainy River and New Afton, if something goes wrong at either one.
It's a big hit. How do they try to mitigate that specific risk? Are they looking for a third asset?
Not really looking for a totally new third mine right now. Their main mitigation strategy is aggressive near-mine exploration. They're spending money trying to find more gold and copper right around Rainy River and New Afton, like the K-Zone prospect near New Afton.
Ah, so extend the life and potential of what they have.
Exactly. Build resilience within their existing footprint, rather than diversifying geographically, which brings its own set of risks. Another weakness is their historical underperformance. They still need to consistently deliver to fully shake off that past reputation.
Build back that trust.
Right. And finally, those relatively low liquidity ratios, like the current ratio below 1.0. As we discussed, it seems manageable with their cash flow, but it requires careful management of working capital.
Got it. Now for the upside. Opportunities.
Lots of potential here. Significant exploration upside is key. Finding more high-grade stuff near their existing mills could dramatically improve economics and extend mine lives. Then there's the potential for margin expansion in a bull market. If gold and copper prices stay strong and they hit those lower AISC targets, their profit margins could explode upwards. That leads directly to more free cash flow.
Which could mean?
Exactly. The initiation of shareholder returns. Starting a dividend or buyback program could attract a whole new group of investors once the FCF is consistently strong.
Okay, lots of potential upside. But we need to balance that with the threats. What keeps management awake at night?
Number one has to be commodity price volatility. Being unhedged means they ride the wave up, but they also crash down if prices turn against them.
And the big one you mentioned.
Operational execution risk. This is probably the most significant threat right now. Flawlessly ramping up 2 complex underground mines is hard. Any delays, cost overruns, or technical problems would seriously damage the turnaround story and investor confidence.
Especially given their history.
Precisely. Then you have broader macroeconomic factors. Inflation hitting input costs like energy and labor, potentially higher interest rates if they need to borrow more down the line.
What else?
Regulatory and permitting risk is always there in Canada. Even for expansions, the process is rigorous, involves environmental reviews, First Nations consultations. It can take time and add uncertainty. And finally, geopolitical factors, even indirectly. Things like the U.S. tariffs mentioned for 2025 could disrupt equipment supply chains, causing delays or higher costs.
Of all those threats, which one do you think is most critical for them right now, especially considering the past challenges?
Operational execution, hands down. Delivering on the C-zone and intrepid ramp-ups, hitting those cost targets quarter after quarter, that's what they absolutely have to get right to validate this entire turnaround narrative. Everything else flows from that.
Makes sense. Okay, we've covered a lot of ground. Let's bring it all together in Chapter 7. Conclusion.
All right. Synthesizing the bull case. New Gold looks like it's genuinely at an inflection point. Years of investment are starting to bear fruit. They have a clear, defined path to potentially grow production by over 50% and slash AISC by maybe 50% by 2027. If they do that, they become a low-cost producer.
And the cash flow starting to show up.
Exactly. Imminent and growing free cash flow, evidenced by that record Q2 2025 number. Plus, you have jurisdictional safety of Canada, real exploration potential, and a strong tailwind from the gold and copper bull market. It's a compelling story if they deliver.
Okay, now the bear case. What are the main arguments against NGD?
Execution risk is paramount. We keep saying it, but it's true. The entire thesis hinges on pulling off these complex mine ramp-ups, and their past record makes investors understandably cautious.
The concentration risk, too.
Yes, relying on just two assets is a vulnerability. A major issue at one mine could cripple the company, and being unhedged means they're fully exposed if commodity prices fall hard. Finally, there's the argument that maybe the recent stock run-up already prices in a lot of the turnaround success.
Given those risks, how reliable is that intrinsic value range we talked about, the $6.50 to $8? Is that really achievable?
It's achievable if the assumptions hold true, primarily the operational execution and the commodity prices. The DCF model provides a framework, but it's not a guarantee. If they hit snags, that intrinsic value estimate would definitely come down. It highlights the potential, but also the dependence on performance.
So recapping the valuation summary, that educational DCF model, using conservative inputs, suggested $6.50 to $8 per share intrinsic value. So putting it all together for a concluding outlook, the stock is trading around $5.90 as of Sep 3, 2025. That's below the low end of that estimated intrinsic value range. It suggests the market is still applying a discount, likely for that execution risk and maybe lingering memories of past issues.
Yeah, future performance really boils down to consistent delivery. They need to keep proving it quarter after quarter.
Can you give us a quick scenario outlook? Base, bull, bear.
Sure. Base case. Let's say gold averages $2,800. NGD hits the midpoint of their guidance. You'd expect strong FCF, they'd pay down debt, maybe start thinking about dividends or buybacks. Stock probably sees moderate upside from here.
Okay. Bull case.
Bull case. Gold goes wild, maybe $3,700, $4,000 plus. NGD not only hits guidance but beats on costs. Maybe they announce a significant exploration discovery. Then you could see a substantial re-rating of the stock, potentially well above that intrinsic value range.
But in the bear case.
Bear case. Gold price falls significantly, maybe back below $2,200. More importantly, NGD runs into technical problems or delays at Rainy River or New Afton. They miss guidance, especially on costs. That would hammer free cash flow and likely hit the share price very hard. Execution stumbles are the biggest bear trigger.
Okay, that lays out the possibilities well. Here's a final thought for everyone listening. Considering New Gold's history, those past struggles against their current strategy, which seems very clear and focused, how much weight do you personally give to a company's past track record when you're evaluating its future potential, especially when it looks like they might be at a real inflection point?
It's tough, right? The past informs the risk, but the present execution determines the outcome. It's a classic investment dilemma.
A very powerful thought indeed. That wraps up our deep dive into New Gold Inc. Thanks so much for joining us today.
My pleasure.
And remember, if you want more analysis like this on mining companies, or if you have a stock you want us to dig into, please do like this video and subscribe to the 1 Tray Ounce YouTube channel.
Definitely let us know.
Before you go, just a couple of important reminders.
Yes, please remember that this analysis was generated by an AI system. It's intended for educational purposes only and absolutely should not be considered financial advice. Always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.